Hey YouTube, this is Zach with Achilles Financial, and today I'm going to be looking at the Redfin website, and they have a particular link that I'll have in the description down below titled or showcasing the United States housing market. The reason why I want to showcase this information is because we're getting ready to have another series of potential Fed hikes, or I say potential, the expectation is that it is nearly definite, and the question right now is whether that's going to be 75 basis points or 100 basis points. Right now, independent of that information, Redfin has this as a national average 30-year fixed mortgage rate of 5.2%. However, the average mortgage rate per the Fred data did cross 6% this year, and that was the first time we'd seen that since 6%. In alignment with some of the other outstanding data not related to housing, we saw last week that FedEx warned of a massive slowdown in shipping, especially over the last few days of the quarter or weeks of the quarter. We are also seeing here on the screen that housing prices are beginning to decline. Right now, they're down 6% in 2 months. Credit card debt is currently up by 30% over the past 4 months. So the question is, what do we expect to happen on a go-forward basis? Well, right now, some of the things that are continuing to keep home prices up involve the fact that unemployment is still below 4%. So we continue to see buyers continue to maintain that income and things are moving along there. We also see that housing, which is the number one source of wealth in the United States, continues to stay pretty high. Again, we're only 6% off those all-time highs. We do have people continuing to spend the money in their savings, and we also continue to see growth in certain areas of the economy. However, I'm interested to see, are these going to continue? One of the things that you can see here in terms of the number of homes selling right now is we're currently down 20% from where we were a year ago. Now, where we were a year ago was still record high compared to what we've seen historically. The question is, where are we going to be on a go-forward basis? So what we're going to be watching for this week that I think is going to have a massive impact is going to be that Fed meeting this week, where we could potentially see a 75 basis point or a 100 basis point rise in interest rates that will affect a lot of broader components of the economy. But the one that I'm closely watching is going to be housing, because there is a big difference right now in terms of how those payments react. So you can see right now, when we're going back to a year ago, so last year in September, interest rates were 2.9%. Right now, even using the data right here at 5.2%, that is a massive increase. However, when we take that to 6.3%, right, which is where it's at right now, a monthly payment on a $500,000 loan is current, or last year was $2,030. Right now, that is up to $3,100. The question is going to be what happens going forward. However, we've already seen some impact on the overall market. The first thing that I would highlight is you are seeing supply, the number of homes for sale, continues to increase from where we were last year during this point in time. Well over 1 million homes, which last year is how we saw some of the declines right here. It was some of the lowest on record. The question going forward is, how are we going to see this months of supply increase? Months of supply is, strictly speaking, going to be the amount of time it would take to sell all of these homes. You can see that the time on the market is beginning to pick back up again. And the question is going to be is if we get this back to what I would describe as a more normalized time period, which is more than double from where we are today. Now, watching this going forward, we continue to have an idea of how this can negatively impact the broader market. The question is, how is that going to happen? And what are we going to see that impact from a broader wealth perspective? Well, right now you're seeing homes selling above list price, and that's continuing to be the case. Last year was insane or earlier this year was insane, as well as last year, where more than half of all homes that were selling were doing so above list price. However, we're starting to see that decline in home prices, especially with homes dropping, and you are continuing to see that homes are continuing to sell when they're listed. The question is going to be is, do we see this continue to pick up, this continue to decline, and are we going to see people begin to list their homes and be unable to sell them? That's what we're going to be watching for going forward. With another rate hike, with those payments continuing to go up, and with consumer confidence continuing to decline, I expect you're going to see some pain here. One of the reasons why we continue to see such incredible increases in home purchases over the past few years was largely due to investors purchasing those homes. It is very easy to get positive cash flows on a 2.5% to 3% interest rate. The question is, can you still continue to have a positive cap rate or a strong cap rate and positive cash flows based on a 5.5% to 6% interest rate, especially if these are non-owner occupied mortgages? I think that this is where you're going to begin to continue to see some pain. Now, some of the things that I would call out in terms of the trends here, you are continuing to see people move from higher cost living areas to a more metropolitan area that has lower cost of living. The question is, are we going to see states like Florida, states like Arizona, where we saw large declines in home prices during the 2007 to 2010 time period? Is that going to impact them again, or are you going to see some of this migration continue to positively affect home prices there, or at least provide a healthy floor, if not a preventative state of decline? You can see some of those metros here, but again, I will leave that information in the description for you to view at your leisure. So there are a lot of moving parts here. The reason I bring this up and the reason why we want to showcase this is because the question is, where are you going to be putting your money? Right now, housing continues to look negative. Stocks continue to look negative. And the only thing that I am currently watching is the bond market, because right now you can get risk-free one-year yields, in particular in treasury bonds, associated with a 4% return on investment, where in housing, even right now, when you're only 6% off all-time highs, it's difficult to look at that and say that that is going to be a 100% guaranteed ROI, pending tax benefits, pending cap rates, and rental rates on a go-forward basis. So there's not a lot of pretty places to look at in real estate. This is something I've been asking on Twitter, but let me know in the comment section down below what your thoughts are on real estate as an investment right now, or what stocks you're looking at. And in the meantime, I'll continue to educate and talk about the bond portfolios that I think are going to continue to be high performers on a go-forward basis. In alignment with some of those items right there, I would just remind everyone I am by no means a financial advisor. I'm just some guy on YouTube. Thanks for watching if you made it this far, and I'll talk with you later.